Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Franco-Nevada stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Franco-Nevada is a Canadian company that owns royalties in gold and other commodities. The stock is traded on the Toronto Stock Exchange and New York Stock Exchange. The old Franco-Nevada was a publicly traded listed company on the Toronto Stock Exchange from 1983 to 2002. In 2002, Newmont acquired 100% of Franco-Nevada. Newmont maintained Franco-Nevada as a royalty holding division, transferring numerous other royalties to it following the acquisition, building its portfolio of royalties to include investments in almost 300 royalties, 2/3 in precious metals, and 1/3 in oil and natural gas. In 2007, Newmont spun off Franco-Nevada in an IPO. Let's get started with the model. This is a large cap company, 24.5 billion market cap. They're trading at $127.93 a share, and they have 191 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the free cash flows into the future, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow in 2017 and 18, but positive in 2019 and 20. Net income is a profit and loss for the company. It's revenue minus expenses. And the company has positive net income every year. Revenue is a sales for the company, and that grows at a pretty good rate, $675 million in 2019, up to $974 million in trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. You can see that grows each year. Below that is cost of revenue. The difference is gross profit, and that also grows each year, up to $500 million in 2020. They don't have too much in operating expenses, so their operating income is pretty high. The company doesn't have too much debt, so they have a small interest payment. They had this big negative $261 million in other income and expenses. That was due to an impairment charge. Their net income in the trailing 12 months was lower because of that impairment charge when compared to 2019, but it's still positive. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then there's capital expenditures. These are investments in property, plant, and equipment. And when you take operating cash flow minus CapEx, you get your free cash flow. And you can see that was negative in 2017 and 18 because they had a lot of CapEx those 2 years. Especially in 2018, nearly $1 billion of CapEx. And it can be common for certain years to be larger CapEx years. CapEx isn't always the most predictable because sometimes the machine can break down and you have to buy a new machine, or you may need to buy a new factory due to increased demand. The company does generate a good amount of cash flow from its operational business. It did take out $670 million of debt the past 4 years, but they paid back more debt than they borrowed. It looks like they issued $136 million of capital stock in 2019 and $188 million in 2020. And the lifeblood of any business is the operations. If a company doesn't have operating cash flow, it needs to eventually have positive operating cash flow or it cannot survive. This company has positive and healthy operating cash flow each year. And the way you calculate operating cash flow, it's net income, which was $263 million, and then you add back the non-cash items. They had $246 million in depreciation. They also passed through a $271 million impairment expense, but that's a non-cash item, so they have to add that back to the statement of cash flows. So that operating cash flow was the highest in the trailing 12 months, $742 million. Let's look at the capital structure. They have $5 billion of equity, $83 million of debt, and their net debt is negative $50 million, so they can pay down all their debt with the cash on their balance sheet. They have a low interest rate on their debt, 1.8%. The cost of debt is 1.5%. And they only have 2% debt in their capital structure. They're 98% equity. Cost of equity is 6.08%. And they have a low beta, 0.49, so the stock moves half the market. And their WACC is 6%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $28 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $25 billion. We divide that by 191 million shares. And we get a calculated stock price of 130. They're trading at 128, so they're trading at a 2% discount. It's a buy according to the model, but it's a really small buy. Simply Wall Street's a lot lower than me. They're at $75 a share, so they're saying the stock is a sell. The stock was pretty steady for about 3-4 years, but it's been driven up for about 6 months here, and it looks like the stock has declined a little bit the past 4 to 6 weeks. And it looks like the company raises their dividend each year. It's up to 26 cents a share, and they pay a 0.81% dividend yield. That's a 75% payout ratio. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $45,000 today. If you did not reinvest the dividends, you'd have $42,000 today. The stock has outperformed the S&P, up 29% in the past 52 weeks. That's pretty much double the S&P. And the 52-week low was 77, the high was 166. And the stock is trading below its 50-day and 200-day moving average, so it's on a downtrend. When the 200-day moving average crosses above the 50-day moving average, that's a death cross. That's a bearish signal. And the trading volume is pretty low for this stock. 660,000 shares are traded each day. And almost all the shares outstanding are on float, so they're available to investors. And nearly 3/4 of the shares are held by institutions, so institutions appear bullish on the stock. A really low short percentage, under 1% of the shares are shorted. This company is a streaming and royalty company. It doesn't own or operate any mines. The company buys commodities from third-party miners by financing their operations. The company started in 1983 as a gold exploration company. At the time, the company was doing oil and gas royalty ownerships. In 1985, the company raised $930,000 to purchase gold royalties. In 1986, the company made its first royalty investment. It acquired 4% of the revenues from a mine in Nevada, and that investment was $2 million. By 2002, that investment generated $23 million a year for the company. In 2010, the company took over Gold Wheaton, a purchaser of gold byproducts, for $830 million. In 2012, the company invested $1 billion in various metal streams from the Cobra Panama copper project. In 2012, the company acquired a 12% stake in Wyburn Oil for $400 million. In 2014, the company invested $648 million in the Candelaria mine. And then in 2016, the company spent $100 million to get the royalty rights for the Oklahoma Stack play. Let's look at the financial ratios. The average PE in the market's 12.2, the median is 14.8. PE is stock price over earnings per share. They're at 93, so they're much higher than the median and average. Price of sales is stock price over sales per share. They're at 25.1, also a lot higher than the median and average. Price to book is stock price over book value per share. They're at 4.8, pretty close to the average in the market. And the way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $5 billion of equity. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. ROE is net income over equity. They're only at 5%, so they have a pretty low ROE. Current ratio is current assets over current liabilities. They have more than enough current assets to cover their current liabilities. Their current assets are $132 million of cash, $98 million of receivables, and $17 million of prepaid assets. They look like they're well capitalized. They had $560 million of free cash flow, and they have $225 million of working capital. The best way to look at ratios is to compare them to similar companies. I've done videos of 8 companies in the same industry as Franco-Nevada, and if Franco has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse than all the price multiples. They do have a really high current ratio. ROE, they're positive. The average in the industry is negative. They're really low in debt, only 2%. And they're the second biggest company on this list. Barrick Gold is the only company that's bigger. And they do pay a dividend higher than the average. So to summarize, even though it's a pandemic, the company is performing better than ever. Their revenues and profits are doing really well. The stock has a low beta, so it's not too volatile, so it won't make too many big movements, but if you hold it for a long term, you should do well. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.